Namaste candidates. This video discusses a 20-week study plan for the FRM Part 2 exam. My name is Mickey Midha and I am the lead instructor at MidhaFin. I became FRM certified in 2012 and I've been training students, candidates for the FRM exam over the last 11 years. Now, over this time, I have seen the syllabus evolve a lot to reflect the current industry trends. This year also, there have been significant changes and we have highlighted those changes in a separate video. So you can just go and watch that video before you see the study plan video. Now, as you know, the FRM Part 2 exam, it actually contains 6 modules. So we have market risk, we have credit risk, we have operational risk, liquidity risk, investment management and current issues. Now, the study plan will try to break down these subjects into manageable segments so that you can ensure a balanced and thorough understanding of each topic. So let's start with week 1. So in week 1, we have these chapters: estimating market risk measures, MR1, then non-parametric approaches, parametric approaches, and backtesting and VAR mapping. So this first chapter, estimating market risk measure. Now this chapter provides a foundational understanding of market risk measures, which includes some concepts and of course some metrics as well. Now concepts like VAR, value at risk, they are introduced here, which actually leverages the students' or candidates' previous knowledge from FRM Part 1, where the basics of VAR were covered. Then we have non-parametric approaches. It discusses methods like historical simulation, which actually do not assume any kind of distribution, normal distribution of returns. Now, students have already encountered non-parametric methods in Part 1, which will actually help them understand these approaches and applications in estimating market risk and prepare well for Part 2. Then MR3, parametric approaches, extreme value. It focuses on parametric methods, especially dealing with extreme values. So extreme values are very critical in understanding tail risk. Now this also builds on the Part 1 concepts, where we had some normal distributions and all those things. So distribution assumptions will be there. And then we have backtesting VAR, the 4th chapter. It actually covers the techniques to test the accuracy and reliability of VAR models. Now, estimation of VAR you've already learned in Part 1. So this chapter will deal with the validation of those models, which of course is a natural progression. Now, VAR mapping, the 5th chapter, it actually discusses the techniques of breaking down the portfolio into simpler components to manage risk in a more effective way. Now, this is also, of course, an application of VAR and it builds on the concepts of VAR. Now, all these 5 chapters, they are dealing with the estimation and application of VAR, which actually ensures a continuous learning curve for you. So you start with introduction, then you move through different kinds of approaches, non-parametric, parametric, and then finally these applications. And all these 5 chapters, they are a bit quantitative in nature. The quantitative methods and approaches which we have discussed in these chapters, they also build on the Part 1 curriculum, specifically the quantitative risk management techniques. So this will also help you in the continuity, right, from Part 1. Now, next week, week 2, we have investment management, IM, risk management and investment management. So we start with analytical methods, portfolio risk analytical methods, then VAR and risk budgeting, and investment management, risk monitoring and performance measurement, and finally portfolio performance evaluation. Now, portfolio risk analytical methods, it actually introduces different kinds of analytical methods to assess portfolio risk, which includes measures like, again, those measures which we have studied in Part 1, like standard deviation, beta, correlation, all these things. So again, all those things, the quantitative risk measurement things, the portfolio theory, modern portfolio theory that we have studied a little bit in the CAPM chapter, and risk metrics, all those things, it builds on those concepts. Then you have VAR and risk budgeting in investment management. It will explore how VAR can be applied in the context of investment management, which includes the allocation of risk budgets across different assets. Now, students have already, again, learned about VAR in detail. So you can just understand and deepen your understanding of risk allocation and budgeting in this particular chapter. Then we have risk monitoring and performance measurement. So it discusses the techniques for ongoing monitoring of the portfolio and the performance measurement using metrics like, whatever we did in Part 1, tracking error, information ratios, all those things, Sharpe ratio, then all those concepts which were introduced, trainer measure and all. Okay. Then we have the 9th chapter, which is IM8, which is the fourth chapter of week 2, by the way. So portfolio performance evaluation. This is also in continuation of performance measurement and evaluation techniques covered in part 1, which will give you a very comprehensive overview of overall performance assessment of a portfolio. Now again, why these chapters? We have clubbed these chapters together immediately after the market risk chapters, because all 4 chapters, they focus on different aspects of investment management, and there are some VAR. I mean, just like we had VAR in the first week, so VAR application is also present in these chapters as well. Okay, it is a central theme in many chapters. If you see IM6, you actually see how VAR is integrated into different investment management practices, from risk budgeting to performance monitoring. And this week also is more or less quantitative in nature. Whatever we have learned in part 1, many of those things will be applied. Now let's go to week 3, which is again, we come back to market risk. First chapter, some correlation basics, properties, motivation, terminology, then empirical properties, then you have financial correlation modeling, bottom-up approaches, and this chapter, volatility smiles, has also been included, and this is maybe not very closely related, but this has also been included. Now, the first chapter, some correlation basics, it will introduce the fundamental concepts of correlation, its properties, the properties of correlation, the terminologies which are used in different financial contexts, and it will cover financial correlation risk also. We have done correlation, but we have not covered correlation risk separately. Okay, very briefly we have covered. So concentration risk, systemic risk, all these things will be covered, and it is important. It provides a foundation for understanding how correlation impacts financial products and different kind of risk measures. Then we come to empirical properties of correlation, MR8. MR8, it explores the empirical characteristics of correlation, like say behavior in different economic states, mean reversion, fitting for equity correlation, bond correlation, all those things. That will also, you can say, enhance your understanding how correlations, they actually behave in the real world. Now we have MR9, bottom-up approaches. So it discusses bottom-up approaches to model financial correlations, which will focus a little bit on copula functions. Okay, it was introduced in part 1, just in a very brief, you can say a very compact section, but then it was not covered in detail. So copula is covered over here, and some more sophisticated modeling techniques that will be applied to the statistical methods that you actually learned in part 1. Now this chapter, as I said, MR15, volatility smiles will actually deal with the volatility smiles, volatility skews, implications on option pricing. It will connect to all the volatility concepts which were introduced in part 1, and in fact it will extend them to more very complex financial instruments. Okay, so it also focuses somewhat on correlation. That is why we have included it. I mean, these chapters are interconnected through their focus on correlation and their application. Okay, and each chapter is actually building on the concepts like correlation and volatility, which were there in part 1. So you can see that initially we are covering all those chapters which have a you can say linkage with FRM part 1 syllabus. So these chapters will provide the necessary theoretical knowledge, practical knowledge to apply whatever you have learned in part 1 in real world scenarios. Okay, now volatility smiles. While volatility smiles, it deals primarily with volatility only, but still it is closely related to correlation. How? Through pricing of options. So that is why this chapter has been included, okay, to make you understand how the market variables interact. Now you see, after MR9, actually, we have skipped the chapters MR10 and all, and we have actually included MR15 because there is an interplay of volatility with correlation. That is why we wanted to make sure that you understand, you're able to appreciate that linkage. Now let us come to the next week, which is week 4. You can see we have empirical approaches to risk metrics and hedging. We have science of term structure models, evolution of short rates and the shape of the term structure, art of term structure models, drift, and again art of term structure models, volatility and distribution. So this chapter deals with empirical methods for risk metrics and hedging, as mentioned. which includes the regression hedging, principal component analysis. That was also introduced a little bit in part 1. It deals in detail with principal component analysis. It also deals with the drawbacks of some DV01 neutral hedges. Okay. Then you have science of term structure models. So it covers the principles of term structure models as mentioned over here, which will include binomial trees. Again, something which was introduced in part 1, the binomial tree model. It will discuss arbitrage pricing, risk neutral pricing, and also some concepts related to option adjusted spread and all. Okay. Then we have evolution of short rates and the shape of the term structure. So this chapter explores how interest rate expectations, volatility, convexity, all these things, they affect the term structure of interest rates, and how you can price zero coupon bonds which incorporate risk premiums. Okay. So this is a very, very interesting chapter. Let's come to MR13, the art of term structure models, drift. Now it focuses on modeling short-term interest rates with drift, which will include some models like Holy model, Vesicek model. Vesicek was introduced, a different version of Vesicek was introduced if you remember in part 1. But over here it's a different model. We will see the possibility of negative rates also. Okay. So there will be drift, mean reversion. These concepts are actually very important to understand modeling interest rates movements properly. Okay. And then we have MR14, the last chapter of this week, the art of term structure models, volatility and distribution. It also complements the previous chapter. It focuses on volatility and distribution in term structure models, which will give you more comprehensive view of interest rate modeling. Okay, so all these 5 chapters starting from MR10 to MR14, they are also kind of, you can say, they can be studied together. They are a bit interconnected because their focus is on term structure models and the factors influencing interest rates, which is actually a progression from empirical approaches to advanced, you can say, risk modeling techniques. Okay, and the behavior of short-term rates is also very crucial. I mean, those who are in the industry, they know that it is very important for interest rate management if you are able to model the short-term rates. Now let's come to week 5, investment management. Again, we go back to investment management. We cover IM1, factor theory, IM2, factors, IM3, alpha, IM4, portfolio construction, and IM5, hedge funds. So factor theory, it actually discusses factors which impact asset prices and the theory of factor risk premiums, which will include something again which you have discussed in part 1, CAPM, and the extension of CAPM, multi-factor models. Okay, so it will give you an idea of how factors, they influence the returns of assets. Now let us come to factors. Now factors chapter, it actually deals with value investing. You will see very good examples using different real world portfolios. Okay, some very famous ones. And it will also extend the understanding from this chapter. Factor investing by it will detail specific factors, their impact on asset returns, and it will build on the theory that we studied in IM1, the first chapter. Then you have alpha and the low risk anomaly. So it covers the low risk anomaly. We'll see that when you study that chapter. You have alpha calculation, you have Greenhold's fundamental law of active risk management, all these things. So then you have IM4, which is portfolio construction. This chapter examines the inputs and methods for portfolio construction, which include transaction costs also. Okay, rebalancing, various portfolio construction techniques as mentioned. Now let's come to hedge funds. Now hedge funds might, again, I mean, this is an anomaly. This might also sound like an anomaly why I have clubbed hedge fund with these 4 chapters. But if we are including hedge fund, it discusses the hedge fund industry. It including, you know, biases, different kinds of biases. And maybe it might not be heavily related to the first 4 chapters, but it provides still a comprehensive overview of hedge funds, their strategies and performance, which fit actually into the broader context of advanced investment management. So this chapter is included because also there is sufficient time, I'll say, in week 5. If you see, we have 4 chapters, so we can add 1 more chapter also, and more or less it is at least somewhat related. Okay, so all these chapters, they are focusing on factor investing, alpha. They are building on some foundational concepts which you discussed in part 1. Again, asset pricing models in VRM chapters, then portfolio theory, performance measurement, all those things are there. Okay. And again, I'm repeating, I mean, if we've introduced the chapter on hedge fund, it simply ensures that all of you candidates, you get a broad view of different investment strategies and their performance. Okay. So you can round out your knowledge of investment management in some way. Week 6, we have credit risk, which has a major overhaul in the syllabus, which we have covered in the separate video, as I said in the beginning. So we start with fundamentals of credit risk, CR1. It will define basic credit risk, how credit risk arises. It will discuss the transactions that generate credit risk, different kinds of transactions, what kind of entities are exposed to it. Okay. And basic concepts, whatever we have done, some of the concepts of credit risk in part 1, this chapter will also build on some of those concepts. Okay. It's an introduction to credit risk. So then you have governance. It discusses risk management responsibilities. There is a very important 3 lines of defense framework, credit origination, risk assessment, all these things will be discussed. And it emphasizes, this chapter actually emphasizes the importance of governance structures in effective risk management. Then you have credit risk management, the third chapter. It covers elements of lending policies, exposure limits, credit facility, allocation, loan loss provisions, all those things. And it provides some practical insights into managing credit risk within financial institutions. Okay, we have seen some of the governance principles also in Foundations of Risk Management module. So this chapter might build on some of those concepts. Okay, then you have credit scoring and rating. It will introduce some quantitative methods for assessing credit quality, and it will expand the practical credit risk management techniques which were discussed in the previous chapter, CR3. Then you have CR7, credit scoring and retail credit risk management. It analyzes credit risks in retail banking. Okay, differences between retail and corporate credit risk, measures to address retail credit risk, all those things. So whatever concept, the general concepts were introduced over here, it builds on some of those concepts. Okay. Now these chapters, they are also providing a proper comprehensive understanding of initial credit risk, initial proper understanding of credit risk from some basic concepts like say fundamentals, governance, and scoring systems. Okay, all those things. And you will get a proper holistic view, you can say, of credit risk management in retail banking also. Okay. Then we have week 7 CR, again credit risk. We start with capital structure in banks, then introduction to credit risk modeling and assessment, estimating default probabilities, credit value at risk, portfolio credit risk. So capital structure in banks, this is something which actually has been moved from another module, capital structure in banks, and this is also a chapter which a lot of the concepts which you can relate to part 1, expected loss, unexpected loss, okay, economic capital, then all those things which you have studied in part 1, you can relate some of those things over here. Then introduction to credit risk modeling and assessment. This will explain there is a system, CAMEL system. It evaluates financial conditions, measurements of credit risk, models to predict default, all those things are there. Then there is one model which is the Merton model also, that will also be introduced over here. Okay, so CR4, you can say it introduced the concepts and those concepts were, some of those concepts were also used in CR5. Then straight away we go to CR9. It is discussing internal and agency credit rating systems first, because it is about estimating default probabilities. So those systems which are used to estimate default probabilities, and whatever assessment we have done in credit risk modeling also, some of those assessments might be used in estimating default probabilities. Okay, and there are other models as well. Then we have credit value at risk, a very, very important chapter. It actually introduces credit VAR, credit VAR, value at risk, as one of the critical measures to assess credit portfolio risk. Then we have portfolio credit risk. It defines and calculates some default correlation for credit portfolios, examines the impact of correlation on credit VAR. It also uses a single factor model for portfolio credit risk measurement. One of the single factor models was also discussed in part 1. Okay, so these chapters again, they have been clubbed together. If you see, we have 4, 5, then 9, 10, and 11. We have skipped some chapters. These chapters together, they are giving you a proper understanding of some foundational concepts like economic capital to some advanced concepts in credit VAR and portfolio credit risk. So, uh, again, you will see when you study these chapters, you will also notice that there is a progression. Each chapter is building on the preceding chapter over here. Now let's come to week 8. Week 8, again, we do credit risk. Okay. Then in this week, we have 1, 2, 3, 4, 5 chapters. Okay. We start with credit risk, CR12. It assesses the credit risks of derivatives mainly. It defines CVA, which is a very important concept in part 2 and in the industry as well, and DVA, and it discusses various credit risk mitigants. It will actually, these concepts of CVA and DVA, they are very, very important for managing credit risk in different financial instruments across, you can say, different institutions. Then we have credit derivatives. Credit derivatives, it discusses derivatives like CDSs, credit default swaps, if you remember, and CDOs, collateralized debt obligations, all those things, and some default probabilities, some valuation part will also be explained over here. Then you see we have a separate chapter on derivatives. We have credit derivatives and we have derivatives. So this actually defines derivatives and it explains how derivative transactions create counterparty credit risk. It will compare exchange traded and over the counter derivatives. Okay. So this is credit derivatives. You can say specifically focusing on credit derivatives instruments, CDSs, CDOs. This is mainly derivatives which deals with the derivatives in general and their relation to counterparty risk. Okay. Then we have CR15, counterparty risk, and beyond it focuses on counterparty risk, which is again a very important aspect of managing credit risk in derivatives. Okay, so it builds on the concepts from CR12 as well as CR13. And then you see straight away we have clubbed CR20 in this week. Okay, so this is a very important chapter. It explains the motivation for pricing counterparty risk. It describes CVA, DVA, different kinds of XVAs, BCVA. In-depth understanding of CVA is there. Okay, and different kinds of adjustments which are required. Okay, this is also something which is very highly relevant for management of counterparty risk. So that's why you can see we have clubbed this chapter with the week where counterparty risk has been taught. Okay, so if you see we have credit risk, derivatives, credit derivatives, counterparty risk, all these things, and again the inclusion of CVA and counterparty risk. This kind of clubbing, it actually gives you a detailed examination of different quantitative methods for evaluating and mitigating credit risk, which will enhance your overall understanding of credit risk. Now let us come to week 9. So these 5 chapters are there: netting, closeout and related aspects, margin and settlement, central clearing, future value and exposure, and then evolution of stress testing counterparty exposures, CR21. CR21, yes, CR21, the last one. So the first chapter, CR16, it explains the purpose of ISDA master agreement, netting, closeout procedures, terminations, provisions, all those things. Then you have the second chapter, which is margin, collateral and settlement. After CR16, we straight away have CR17. Now, it will discuss the rationale for collateral management, okay, and the terms of collateral management, the features of CSA. CSA is the Credit Support Annex. It is within the ISDA Master Agreement, okay. It actually, you can see we have studied ISDA this Master Agreement over here only, and then we study CSA over here in the CR17 chapter. Then we have central clearing. It defines central counterparty CCP. It explains the mechanics of central clearing, margin, default fund requirements. Many of these things you have done in the 3rd module of part 1, in the 5th and 6th chapter, I guess. If you remember, those chapters were mainly theoretical chapters and they dealt with these concepts, some of those concepts. Then you have future value and exposure. It describes and calculates some metrics for credit exposure. It compares credit exposure to VAR methods, and it discusses the impact of collateral on exposure. Okay, so the concepts of netting, collateral, central clearing, all those things can be integrated. Finally, we have evolution of stress testing counterparty exposures. This will differentiate among different kinds of exposure metrics. Okay, it will discuss counterparty credit risk as both credit risk and market risk. It will describe some kind of stress testing also on portfolios. Okay, so it is very crucial for evaluating resilience of financial institutions under adverse conditions. Now, these chapters, they are mainly focused on managing counterparty credit risk, which it is actually, you can see the progression is quite logical, quite natural. So that is why these chapters should definitely be studied in a single week together. Then we have week 10. We start with structured credit risk. This is CR22. It has been pushed quite ahead in this year's curriculum. Earlier, this structured credit risk was probably the 9th or 10th chapter till last time, something like that. 8th, 9th or 10th chapter. Now it is CR22. So CR22, then we have introduction to securitization, country risk, due diligence, and predicting frauds. So CR22, structured credit risk, it actually describes the common types of structured products, then tranching, waterfall structures, and who are the key participants in the securitization process. Okay, then there will be concepts like excess spread, default probabilities, risk factors, different kinds of risk factors impacting different kind of structured products. Okay, so it will give you a foundational idea of structured credit products and the risks associated with with those products. Then you have introduction to securitization. Makes sense to study immediately after CR22. Okay, it discusses a lot of things: securitization process, over collateralization. There will be concepts like first loss piece, equity piece, and then waterfall. Waterfall model was there in CR22 also. It will be cash waterfall over here. So it will complement the understanding of structured products. Then you have CR8, which is country risk. Country risk, if you remember, was also one of the chapters in part 1. And in fact, the author from which they have taken this country risk is also same. The edition is probably different. Okay. So we have country risk, where sovereign default risk measures will be assessed, ratings of countries, sovereigns. Okay. So macroeconomic political factors which impact credit risk. So that is covered in CR8. Then you have performing due diligence on specific managers and funds. So you can see in this week we have CR as well as IM. So it covers the reasons for hedge fund failures, elements of the due diligence process, criteria for evaluating any kind of hedge fund, and provides practical insights into the evaluation of investment managers and funds. Okay. Then you have predicting fraud by investment managers. So it discusses the use and efficacy of information disclosures in predicting fraud, barriers and cost of implementing fraud protection methods. And it will complement this due diligence part which you studied in the previous chapter by focusing on the identification and prevention of fraud. Okay. And there was a specific reason why these chapters, I mean, it makes sense, right? 22, 23 to be clubbed together. But see, not every, it is not possible for us to have chapters in every week which will be highly related to each other. Yes, we will try as much as possible to relate those chapters together, okay? But they are somewhat related. These two are very tightly related. These three are, you can say, loosely related with CR22 and CR23. So they offer theoretical knowledge, all these chapters, and practical insights which are necessary for managing risks in various contexts. And the inclusion of chapters on due diligence and fraud prevention, it is also giving you a comprehensive view of investment risk management techniques, which you can say, if you combine it, if you combine it with credit risk, structured credit risk and securitization, it is actually giving you an interaction between credit risk and investment risk. That's it. So, and there is a lot of practical relevance. If you see, even though these chapters are theoretical, all these chapters have a lot of practical relevance, a lot of real world applications. Now let us move on to liquidity risk. We start liquidity risk in week 11. So we have liquidity risk LR1, then we have liquidity and leverage, we have illiquid assets, we have liquidity and reserves management, we have monitoring liquidity. So the first chapter, liquidity risk, it explains and calculates liquidity trading risk. It discusses liquidity funding risk. it evaluates Basel III liquidity ratios and some BIS principles. So you'll get a good foundational understanding of liquidity risk, and the concepts from this chapter will be used in later chapters as well. Then LR2, liquidity and leverage. It differentiates between sources of liquidity risk. It summarizes the asset liability management ALM process, and it compares transactions used in the collateral market. Okay. Then you have illiquid assets. You can see after LR1 and 2, we are straight away going to LR19. LR19, illiquid assets, it was actually earlier when liquidity risk module did not exist before 2020. It was a part of operational risk module earlier. Okay. In 2020, it was moved to liquidity risk. So it is it enhances the understanding of how market imperfections and all those things, they impact financial assets and how assets can become illiquid. Then we have liquidity and reserves management strategies and policies. So it will focus on practical strategies for managing liquidity and reserves in banks. It will integrate concepts from these previous chapters on liquidity risk and ALM in particular, asset liability management. Then you have monitoring liquidity, LR7. Okay, after LR5, we go to LR7. It distinguishes between deterministic and stochastic cash flows. Okay, then you'll see some liquidity options. Okay, some term structure of expected cash flows also. Okay, so you can see that this chapter is providing you methods for monitoring, managing liquidity. Now, these 5 chapters on, you can say, if you compare the chapter, let's say reserves management and say monitoring liquidity, these 2 chapters are providing practical methods for assessing and managing liquidity, which are actually integrating some of the theoretical concepts which you learn from LR1 and 2. Okay, now moving on to week 12, again we'll continue with liquidity risk only, LR only. So we have early warning indicators, we have intraday liquidity risk management, liquidity stress testing, liquidity risk reporting and stress testing, and contingency funding planning. Okay, these 5 chapters are there. Now, early warning indicators, LR3. Now, it evaluates, as mentioned in the name, the characteristics of sound early warning indicators, or they will be abbreviated as EWIs. Okay, it will also discuss guidelines from regulators and their applications in liquidity risk management. And it will help you to identify and use EWIs to manage liquidity risk, basically, which is very important for proactive risk management. Okay, so when you see this chapter, you'll understand what I'm saying. Now, the second chapter, intraday liquidity risk management, it identifies uses and sources of intraday liquidity, governance structures, okay, all those things, and it actually focuses on mainly the management of intraday liquidity only, which is very, very important for real-time risk management, okay, and also operational stability. Then you have liquidity stress testing. It differentiates between different types of liquidity. It estimates contingent liquidity, then different kind of stress tests, okay. So it provides insights into how financial institutions, they prepare for and they manage potential liquidity crisis. Then you have liquidity risk reporting and stress testing. Okay, so it identifies best practices for reporting a bank's liquidity, and it explains the process and interpretation of liquidity stress test reports. Then you have contingency funding planning. So it discusses the relationship between contingency funding planning and liquidity stress testing, and it evaluates some design considerations and components of a contingency funding plan. So it is actually integrating the concepts of stress testing and early warning indicators by focusing on contingency funding plans, which are very important for, again, managing liquidity during times of extreme financial stress. Okay. Now, all these 5 chapters, they are highly interconnected, okay, through their focus mainly on proactive liquidity risk management, which I said in the beginning. Okay, so the chapters on stress testing, reporting, contingency planning, they're also providing you practical methods for assessing and managing liquidity. So week 13, again, we are continuing with liquidity risk. So we have managing and pricing deposit services, we have managing non-deposit liabilities, we have repurchase agreements and financing, and failure mechanics of dealer banks, risk management for changing interest rates. Okay, so all these 5 chapters are somewhat related. Managing and pricing deposit services, the first chapter, LR12. Now, it differentiates between various transactions and non-transaction deposit types. It will compare pricing methods and it will explain challenges faced by banks offering deposit accounts. So it will give you a foundational knowledge on managing and pricing deposit services, which are very important for understanding broader liquidity risk management strategies. Then let's come to managing non-deposit liabilities. So this actually differentiates between different sources of non-deposit liabilities and it describes the available funds gap. It also calculates, this chapter deals with the calculation of overall cost of funds. Now this chapter builds on the understanding of deposit services in the previous chapter by addressing the management of different other types of liabilities, okay, which are important for overall comprehensive liquidity risk management. Then let's come to repurchase agreements and financing. It describes the mechanics of repurchase agreements, motivations for entering into repos, how counterparty liquidity risk can arise through these repo transactions. Okay. Then let's come to the failure mechanics of dealer banks. So it compares the major lines of business in which dealer banks operate. It identifies situations causing liquidity crisis and assesses policy measures to mitigate these kinds of risk. Then the final chapter, risk management for changing interest rates, asset liability management and duration techniques. So it discusses basically asset liability management strategies, interest sensitive gap management, duration gap management, okay, to hedge against interest rate risk. So it complements the understanding of liquidity risk by addressing how interest rates impact liquidity and overall financial stability. Now, the application to liquidity risk is very heavy. If you see these chapters, the practical application, understanding how to manage deposit services, non-deposit liabilities, repurchase agreements, and prevent dealer bank failures. These are all very important for liquidity risk management. Okay, you will also get theoretical as well as practical insights which are necessary for managing liquidity risk in different contexts. Okay, and the inclusion of chapters, the last one on asset liability management, duration techniques, it also provides a comprehensive view of managing interest rate risk, which is again closely related to liquidity risk. Okay, so now let's move on to week 14, where we'll finally conclude the remaining chapters and we'll conclude liquidity risk. We'll cover all the remaining chapters of LR. Then we have 4 chapters over here: liquidity transfer pricing, guide to better practice, investment function in financial services management, US dollar shortage, and covered interest rate parity lost. You have studied covered interest rate parity in FRM part 1. Over here we'll see cases where this does not hold true. So we start with liquidity transfer pricing, LR 15. It discusses the process of liquidity transfer pricing, best practices for governance and implementations, challenges during implementation, approaches to the liquidity transfer pricing. Then we have investment function in financial services management. Now, investment function in financial services management, it compares money market and capital market instruments which affect investment security choices and investment maturity strategies. It also builds on liquidity management by discussing the investment strategies of different financial institutions, which will actually link to the broader theme of managing liquidity through different investment decisions. Okay. Then you have US dollar shortage in global banking and the international policy response. So this chapter identifies causes of the US dollar shortage during the great financial crisis. It assesses maturity and currency mismatch, discusses central bank swap agreements. So this chapter will actually help you to understand global liquidity issues. Okay, so managing currency maturity mismatches in international banking. Then covered interest parity lost. It will differentiate first between FX swaps and cross currency swaps. It will identify different factors affecting the cross currency swap basis and assess causes of covered interest rate parity violations. Okay, so these chapters together, they are mostly focusing on liquidity management and transfer pricing, which is you can say from internal bank management. It is a logical progression to global liquidity issues. Okay, so understanding these things, liquidity, transfer pricing, investment strategies, managing currency maturity mismatches, is important for liquidity risk management in a global sense. Then now let's move our focus to operational risk. We start operational risk in week 15. Now there are a lot of theoretical chapters, and it is better to study these theoretical chapters, especially of operational risk, as close as possible to the exam. That's why we have shifted operational risk towards the, you can say, fourth half almost of this study plan. You can say quarter of this study plan. The first 3 blocks, if you divide this into 4 blocks, then it will be 5 weeks each. But if you divide it into, say, 5 blocks, it will be 4 weeks each. So you can say if you divide it into 4 blocks, okay, generally I advise the entire plan to be divided into 5 blocks, so that you can take block tests after each block. So after every 4 weeks, you should take a test. But if you divide it into 4 blocks also, even that is okay, you can take 4 block tests. So this will be the last block. Operational risk, you can see it is actually in the last segment of the study plan. So introduction to operational risk and resilience, it is providing the foundational knowledge on operational risk management and resilience to understand the broader scope of operational risk. Then you have risk governance. It explains Basel regulatory expectations for operational risk governance, roles of different committees, board of directors, 3 lines of defense model, and best practices for risk appetite, risk culture. All these things will be discussed. Okay. So you are basically focusing on governance structures, regulatory expectations and all in this particular chapter. Then you have risk identification. So risk identification, it compares top-down and bottom-up approaches for identifying operational risk, best practices in scenario analysis, and the application of operational risk taxonomies. This chapter is also very important. You are able to categorize also operational risk in this chapter. Then you have risk measurement and assessment. It explains the best practices for collecting operational loss data, operational risk assessment processes and tools, KRIs, key risk indicators, provides methods for measuring and, you can say, assessing different kinds of or operational risk, which integrates both qualitative as well as quantitative approaches, both of them. Then finally, you have risk mitigation. It compares ways to address, mitigate operational risk exposures, types of controls, internal controls, control automation, and new products, business initiatives, how operational risk can be mitigated through these things. So practical methods for mitigating operational risks are discussed in this chapter. Strategies to manage transfer risks, all those things are discussed. Okay. So you can clearly see that it makes a lot of sense to have these chapters together, because understanding operational risk frameworks, then governance, identification, measurement, assessment, mitigation, these are all very important for effective operational risk management and understanding operational risk in a you can say a very comprehensive manner, at least the basic operational risk part. Okay, and management of operational risk in various contexts. Now let's come to week 16, where we have started with risk reporting. You can see we have 5 chapters over here: reporting, integrated risk management, supervisory guidance, case study, model risk and model validation, and risk capital attribution and risk adjusted performance measurement. So risk reporting, OR6, it identifies roles and responsibilities of different organizational committees, different components of operational risk reports. What are the challenges in reporting operational risks? What are the best practices for reporting to regulators as well as external stakeholders, not only regulators? So it is important for maintaining transparency and accountability, all those things that you will learn in this chapter. Integrated risk management. It describes the role. So it is very similar to the chapter ERM, right? It deals with ERM framework, the concept of risk appetite, risk culture within the ERM framework, Basel regulatory capital, stress testing frameworks. So it integrates various risk management approaches into a cohesive ERM framework, which emphasizes the importance of you can say holistic approach to operational risk management. Then the case study. The case study, model risk and model validation. So it will actually help you to understand this case study of the risks associated with using models in risk management. Different, you can say, providing different kinds of guidelines for effective model risk management and validation. Okay, sorry, I think I missed one chapter, right? Supervisory guidance. So after OR7, you have supervisory guidance on model risk management. So all the supervisory guidance will be dealt in this chapter only, and after that only we have model risk and model validation. So first you will see supervisory guidance on model risk management, and then you will see model risk and model validation. Then you have risk capital attribution and risk adjusted performance measurement. So when you hear of risk adjusting performance measurement, you immediately you recall RAROC, right? So risk capital, economic capital, RAROC methodology, challenges in using RAROC, best practices in implementing RAROC. RAROC is something which most of the candidates who are working in operational risk or even in credit risk sometimes, they might have dealt with RAROC calculation in their job, okay? Now, all these chapters, risk reporting, integrated risk management, then model risk, and then this risk adjusted performance, they are offering you a very good theoretical as well as practical knowledge. See, that is the irony of part 2. Even though most of the chapters are theoretical, but still they have a lot of practical relevance. The chapters on case studies, performance measurement, they are providing practical methods for assessing, managing operational risk and integrating theoretical concepts with real world application. Okay, so part 1, if you remember, it was highly quantitative in nature, at least the 2.5 modules you can say. But over here, even though it is theoretical, it is more relevant to the industry as compared to, because in your job you're not going to do hypothesis testing directly, right? So the theory part is also very, very important. Now let's move on to this week. You can see there are a lot of chapters in this week. Why? Because these are very, you can say, of course they are connected in some way, but these are very brief chapters. They are not very lengthy chapters, okay? So you have cyber resilience. It will define cyber resilience, compare regulatory initiatives, governance of cyber risk management frameworks, then current practices for supervising cyber resilience. All those things will be discussed, which are important for understanding the broader scope of managing cyber risks in financial institutions. Then you have case study, cyber threats and information security risks. So this chapter describes frameworks and best practices for managing cyber risks. There will be a lesson, Equifax case study. You will see that in this particular chapter. If I remember, it was Equifax only. So it will build on the concepts of cyber resilience, okay, by providing some practical insights. Then you have sound management of risks related to money laundering and financing of terrorism. So it explains the best practices recommended by the Basel Committee for managing ML/FT, money laundering and financing of terrorism risk. Okay, so it will enhance understanding of financial crime risk and regulatory frameworks for managing and mitigating these kinds of risks. Then you have case study, financial crime and fraud. It describes the elements of a control framework to manage financial fraud and money laundering risk. And there will be a case study, USAA case study, which will be there in this particular chapter. Then you have guidance on managing outsourcing risk. So it explains how risks can arise through outsourcing to third-party service providers, and it describes elements of an effective program to manage outsourcing risk. Now, next chapter, the case study on third-party risk management, it will explain outsourcing risk and third-party risk management. They might seem a bit similar, okay, but there is a difference. Outsourcing is particularly related to outsourcing your work to third parties. Over here, it builds on the understanding of outsourcing risk by providing some practical examples and insights into third-party risk management. Then you have case study, investor protection and compliance. So you can see you have 1, 2, 3, 4 case studies in this week. It summarizes important regulations designed to this chapter, designed to protect investors. There is MiFID, MIFID, MIFID 2, Dodd-Frank Act, all those things, lesson learned from these case studies will be applied, will be included, okay, so that the importance of protecting investors is highlighted from real world violations which have happened. Now let's move on to week 18, where we cover OR and one chapter of MR which we left. In fact, we have left 2 chapters of MR. So one chapter of MR will be covered over here, which is fundamental review of the trading book. Rest of the chapters you can see OR 21, 22, 23 and 24. They are all related to regulations mainly, okay, and that is why it makes a lot of sense to have MR16 covered with this particular week. So OR21 explains the motivations for introducing the Basel regulations, key risk exposures and calculation of risk weighted assets, capital requirements, all those things, okay, before the financial crisis. Got it? Then you have solvency, liquidity, and other regulations after the global financial crisis. So it describes and calculates stressed VAR, which was actually introduced. Sorry, it was introduced in Basel 2.5, and it explains the incremental risk capital charge, a very important concept. Then tier 1 capital, tier 2 capital, and COCOs also will be introduced, which a detailed study of COCOs is also there in current issues this time. So these things will be introduced in OR 22. Then you have high level summary of Basel 3 reforms, where the motivations for revising the Basel 3 framework and the goals and impacts of the recent, in fact, not very recent, I'll say, but the not too, you can say, not too behind in the past, December 2017 reform. So it will actually help you understand the evolution of Basel regulation, focusing on some recent reforms like 2017. Then finalizing post-crisis reforms, it will explain the new standardized approach. Okay, there are some changes which have been made, some approaches have been discarded. It will actually explain the new standardized approach, compare it to the earlier methods. Some criteria will be identified to measure, treat operational risk data, which will reflect the ongoing efforts to refine and improve the risk management practices, particularly in operational risk. Now, finally, we have fundamental review of the trading book. Okay, it describes changes to the Basel framework. This also is related to the Basel framework. Okay, it compares various liquidity horizons, revisions in the classifications of positions, back testing, loss attribution, all those things are covered. So you can see it complements the understanding of regulatory reforms which are there in the previous chapter, and how financial stability can be enhanced through regulatory changes. All those things are covered in FRTB. So these chapters definitely are interconnected, right? They are actually giving you a overview of pre-crisis reforms first, and then logically progressing towards the Basel III reforms after the crisis. And FRTB is also very crucial for effective regulatory risk management. Fine. Now let us move on to week 19. Again, we study OR and the final chapter of MR which we left, which is MR6. This also we'll study in week 19. Okay. We start with range of practices. We start with, then we have capital planning at large bank holding companies, stress testing banks, messages from the academy. So if I'm not reading it completely, okay, don't worry about that. If some portion is also hidden, of course, you know all the chapters, right? And I'll also make sure that we have the study plan on the website. So if you want the details of the study plan, the bifurcation and everything, you can make sure that you just click on the link below, okay, in the description. I'll make sure that the link is also attached, and through the website you can access the study plan also, and if you want you can download the study plan in the PDF format also. So if these chapters are not visible when I'm speaking, okay, so no need to worry. I'm saying this for the candidates who are planning to prepare for part 2, but they have not yet started. Of course, if those who have started, those who have an idea of the syllabus, they already know the names of the chapters, right? Now this chapter OR 19, it discusses the challenges in defining and calculating risk measures, risk aggregation, model validation, then dependency modeling is also there. Some elements of counterparty risk is also there over here, okay, in this chapter. So you will see basically some frameworks which are important to understand how banks can manage capital and risk internally, okay. Then capital planning at large bank holding companies, supervisory expectations and range of current practices. So it describes the Federal Reserve's capital plan rule, 7 principles of effective capital adequacy process and practices for strong capital adequacy processes. Some internal controls will also be dealt with. It will also build on some aspects of economic capital, okay, and best practices for capital planning and adequacy in large bank holding companies. Then you have stress testing banks. It gives you the evolution of stress testing process, because stress testing also has evolved a lot over the last few, I should not only say years, but decades, okay, maybe last couple of decades, okay. So it makes you understand how stress testing is used to assess the resilience of financial institutions under adverse conditions. Then finally you have messages from the academic literature, the last chapter MR6. It explains lessons on VAR implementation, liquidity risk integration into VAR model. So you could have said that why we did not include this chapter if there is so much, I mean, there is a discussion of VAR, why we did not include this chapter earlier in the chapters after MR5. We could have done that. We could have included that in that particular week also. But I think since there were only 3 chapters remaining and that particular week in market risk was also already quite heavy. So that is why we placed MR6 with these 3 operational risk chapters. So they are not very tightly related. MR6 is not very tightly related, but yes, it is related to OR 19 and 20 and 17. Okay, they are interconnected through their focus on capital planning, risk measurement, stress testing. Okay, so economic capital frameworks to regulatory expectations, stress testing, specific risk measurement techniques for the trading book in this chapter. So these things you will find that they are interconnected. It was actually, you can say, it is a wise thing to study this particular chapter in week 19, because again, as close as possible to the exam, you're trying to cover these theoretical chapters and a lot of information has to be retained in your mind. Okay, it is better to study MR6 towards the end only in week 19. But again, you have a choice. You can study MR6 just after the VAR chapters also. Now let's move on to last week. So all the current issue chapters we are going to discuss this time. You can see from 94 to 103. So you can see we have done the sequencing in such a way that you can also see the number of chapters. So this is the final chapter, 103rd chapter. Okay, 94 to 103, it means 10 chapters are there in current issue. So we start with a review of Federal Reserve supervision and regulation of Silicon Valley Bank. So it discusses the events which led to, it's a very famous event last year leading to the failure of Silicon Valley Bank, deficiencies in the Federal Reserve's oversight, risk issues, governance, liquidity risk management, interest rate risk management, all these things will be discussed. Then COCO wipeout. So it describes the features and mechanics of COCOs, which has been introduced earlier in one of the liquidity risk chapters, the rescue of Credit Suisse and the rationale for the write down of COCOs, and of course the market reactions after that. Then you have artificial intelligence and bank supervision. It describes AI-based applications in the financial sector, their advantages, disadvantages, issues faced by different banks and regulators. Financial risk management and explainable, trustworthy, responsible AI. There's a lot of debate around AI in the last few weeks. In fact, after so many grand announcements, both by OpenAI as well as Google. So you can see there is a discussion going on where this trustworthy, responsible, explainable AI is being used, right? So ethical considerations, validation of decision-making algorithms, and the application of explainable AI in credit risk management will be discussed in this chapter. Okay, then you have artificial intelligence risk management framework. It explains how organizations can frame AI risks themselves. They can manage these risks. They can achieve trustworthy AI through specific functions and periodic evaluations. Then we move to climate related risk drivers. So it describes climate risk related drivers, their impact on banks mainly, and compares physical and transition risk drivers. Then you have measurement methodologies of climate-related risks. So the issues in identifying and measuring climate-related financial risk methodologies, which are used by banks, regulators, as well as third-party providers. Then we have principles for the effective management and supervision of climate-related financial risks, CI 8. So it describes principles for managing climate-related financial risks related to governance, capital adequacy, risk management, as well as supervision. Then we have the crypto ecosystem, key elements and risks. So it describes the key elements of the crypto ecosystem, the inherent structural flaws in the crypto ecosystem, the risks to various parties, and potential policy actions to mitigate these risks. Finally, the last chapter, digital resilience and financial stability, the quest for policy tools in the financial sector. So it describes the cyber and ICT risks faced by financial institutions, their interaction with financial risks, and potential macro, you can say macro-prudential tools to address these risks. So obviously, the current issues chapters can be covered together in 1 week. Okay, it is more than, I think it is enough. The PDFs that we provide for current issues, we have actually prepared the PDFs where all the learning objectives have been covered properly in detail, but they are not as overwhelming as the original papers recommended by CARP. Okay, so it will be very helpful for you. Just go through our PDFs for CI. Nothing else is required. Okay, and that's it. I think this, yeah, week 20. So this is the end of the study plan. So the study plan, 20-week study plan, this is what we have prepared, but I'd like to emphasize a few key points which will actually help you to maximize your preparation. So the first point is that while this plan is designed to be comprehensive and structured, okay, it is very important to incorporate, as I was saying in earlier, that it is very important that you take block tests. So if you are incorporating block tests at the end of, say, every 4 weeks or 5 weeks, 4-week segment will be ideal. Okay, so these tests, because we have designed the course and we have divided the course into 5 blocks at Midafin. So after every block, we will take a test. So it means that every test should cover the chapters which were studied in the previous 4 weeks or 5 weeks, depending upon what you want to have as one segment. So it will help you to understand and retain all the material, because it is very overwhelming, right? Next point which I want to address is that if you want to prepare for part 2 properly, it will require a lot of commitment. Ideally, you need to devote at least 600 hours over a span of, I'll say, 6 to 9 months, because part 2 is much more overwhelming as compared to part 1. You can see there are 103 chapters, right, in part 2. How many chapters were there in part 1? 62 this year. So much material is there. That is why your study strategy has to be very, very effective. Okay, third point which I want to make is that since part 2 is highly theoretical, the best way to retain this theoretical information is by solving as many questions as you can. Regular practice is very, very important. It is not the case that you should just go on studying the chapters and towards the end you are taking all the tests. No, it should never happen, because you have to retain so much of theoretical information. It is important that after every 4 weeks you take a break and you take a proper test for the last 4 weeks. Some of you might not be following this plan. Some of you might be going for module by module basis. I would advise them to cover market risk first, then investment management. Okay, I mean, based on the study plan, you can try and make your own study plan if you're going on a module by module basis, and then after every module you can take a test. That is one way. But this, what we have done, we have actually, just like part 1, where we say that, in fact, in part 1 it was more important actually, because there were topics which were discussed at in one section in Foundations of Risk Management, but their application part and their mathematical dynamics is discussed in another module altogether. So that's why we clubbed those chapters together and changed the sequence completely. In part 2 also, we have tried the same thing. We have tried to club these chapters together, which are interrelated in some way. Mostly, I mean, it is possible that in some weeks there will be maybe 1 or 2 chapters here and there, which will not be very very tightly or even loosely related to the other 3 or 4 chapters in that particular week. But that has been done because effective time management is also important. Let's say you are getting some more time in a week, then why not club some chapters of say theoretical chapters in that particular week, as you will have more time. Also, you need to make sure in part 2 that, as I said, over a span of 6 to 9 months. Now, what we recommend, see, this is a 20-week plan, but ideally it should incorporate 1 week after each block. So ideally it should be a 25-week plan. Okay. So in that case, what you can do is, if you are preparing, or if you took part 1 in May, okay, and you are a working professional with a very, very tight schedule, then instead of trying to attempt part 2 in November, okay, of course, August is not an option for part 2 after May. You will not be able to do it, and I think they don't even allow it. Instead of planning for November, you go for the next year May. So at least have a span of at least 6 months where you can devote sufficient time. Okay, so if you think that it is going to be too tight, then extend that 6 months to 9 months, 12 months. That is completely okay. In fact, to our candidates, we always say that you should always take at least 9 months. We don't even say 6 months. We always say take 9 months for part 2. So it means if you're taken the exam in August, then you can take the exam next year May. If you've taken exam in May, then since the exam is not held in February, you can directly take the exam of part 2 next year May. So part 1 this year May, then part 2 next year May. But if you've taken part 1 in November and passed the exam, then you can go for part 2 either August or November, because that will give you around 8 to 9 months. Okay, if you go for August. If you go for November, it will give you 1 full year. So this is how you should plan it. Okay. And as I said, I'll make sure that this is available to all of you, the PDF also, and the link to the website. Everything is there on the description section of this video. And if you need any support or have any questions throughout your preparation journey, whether you are MIDAFIN candidate or not, please do not hesitate to get in touch with us. Okay. And thank you for joining us in this video, and best of luck for your FRM Part 2 exam preparation. Namaste.